So welcome to On Investors' Minds. I'm Kerry Craig, a global market strategist here at JP Morgan Asset Management. And thank you for giving us a few minutes of your time today to hear about what's on investors' minds and how that fits in with our current views on asset allocation. Now, today I'm very pleased to be joined by Kyle Hutzler. Kyle serves as an executive director for Asia Pacific Policy and Strategic Competitiveness within the JP Morgan Center for Geopolitics. Now, I won't go through Kyle's full bio, but safe to say it is one that reads very strongly and has a high pedigree in the area of thinking about geopolitics. And so very well positioned to hopefully provide some clarity on what the world is showing us today in geopolitical terms, as well as economic statecraft. Kyle, thank you so much for your time today and joining us. Obviously, we're recording this on June 17th in Melbourne, Australia. Is this your first trip out to Oz?
To Melbourne, yes. Australia, no. I'm actually fortunate enough to have cousins in Sydney. Was able to see them on this trip, and it's very good to be back.
Well, it's fantastic that we have some time with you today because geopolitics, the shape of the world, it's a topic we've written about a lot within the Market Insights team. It's a topic our clients are consistently asking us about, and obviously very timely, with what's happening in the Middle East and hopefully a signing of a memorandum of understanding between Iran and the US later this week. But before we get into all of that, I wanted to just ask you if you could give us a bit of background around what the JP Morgan Center for Geopolitics actually is and where it sits within the broader JP Morgan sort of company.
You bet. So the Center for Geopolitics, we just celebrated our first anniversary. We're led by Derek Chalet, who's the former counselor at the U.S. State Department. We've got more than a dozen colleagues with a range of backgrounds focused on both geographic and thematic, so defense, technology, trade, economic statecraft issues. As you noted, I'm part of our Asia specialist group, spent a lot of our time thinking about U.S.-China, global China, among other topics. And we have the privilege of supporting both our internal colleagues, but also engaging through briefings, through our short written materials, longer public reports, clients on behalf of the commercial investment, private bank, institutional investors, and give them a sense based on the richness that we have as a firm and what we're able to see across the globe to take that policy relevant insights and help them translate that into something actionable.
Yeah, and just to get a plug in early for your research, it is available on the website under the Center for Geopolitical. Center for Geopolitics, and there's a newsletter that people can sign up for to receive. So not tied to JP Morgan Asset Management, but representing the broader group as well. Okay, let's start with the big picture. Obviously, from a market perspective, we often view geopolitics that's something that has a relatively limited long-term impact in investing, unless it involves energy, of course, and then markets tend to pay more attention. However, it's becoming more apparent that we're now living in a period of heightened geopolitical volatility. This is actually having a much bigger impact on how we think about the macroeconomic background, the investment outlook. Given all that's going on in the world today, Kyle, how would you characterize the current environment in this regard? Is this generally part of a bigger geopolitical shift that we're actually seeing around the world, or are we just getting more headlines?
I believe we are seeing a fundamental shift. It feels as though the puzzle pieces have been broken, have been tossed up into the air, and not yet clear how they're going to land and with what degree of coherence yet when they get back on the table. I think we already see through the FDI decisions and shifts there. We see it a little bit in terms of rerouting of global trade. We see it in the shifts in inventory levels that are suggestive of a real internalization of the need to pivot slightly back towards just in case versus just in time. For those give me a sense that companies are making a bet that the trends and the upheaval that we're seeing have some degree of durability.
I think it's more so featuring in our long-term views. When we do our long-term capital market assumptions, we're thinking more about the shift towards populism, the shift towards much more nationalistic focus on sort of industrial policy, how that playing out, the reshoring, as you mentioned, more redundancies being built into supply chains and how that feeds back into the investment opportunities. Bringing it back to the near term, obviously the short term is most focused on the energy market, what's happening in the Middle East, and I guess the announcement we've had this week around potentially reopening the Strait of Hormuz. Very much positive in terms of the outlook for the markets, thinking about what it means for growth and inflation that comes back down a little bit. We recently released our mid-year outlook, and within that, we'd actually sort of put in some scenarios for what would happen in the Middle East because we published it before the announcement. When it comes to what we have now in front of us, when you think about the potential scenarios and where we're heading, what is the outcome from this US-Iranian negotiations that we're now entering into?
You bet. Peace is better than no peace. It feels as though we have returned more or less to where we were before the start of hostilities. Both sides, however, having reason to believe that they are entering the next phase of negotiations over the fate of the nuclear program with greater leverage. The U.S. And Israel, through the joint strikes on Iran's military capabilities, degraded, but by no means eliminated, and therefore able to exercise on Iran's part the threat to the Gulf, which proved to be so effective. So both sides now will see. It's difficult to imagine that we're going to get an agreement at the end of this that is materially different than the Obama era nuclear agreement in terms of enrichment and stockpiling, all intended to push back the breakout period in which it would be likely for Iran to, if it chose to achieve a nuclear weapon. So we'll let the diplomatic process play out and hope for what will be a more favorable outcome than what devolved into the hostilities. The other question in this moment is the role of Israel, who was not in support of the original nuclear agreement during the Obama administration, what role they will play in trying to shape the outcome in the coming weeks is probably the most important outside factor beyond what's happening in the minds of those in Tehran and Washington.
Yeah, I mean, that's a great segue to my next question. So you talked about the military capabilities being degraded but not eliminated. I mean, from my perspective, when we're looking at the markets, we're thinking about where the energy prices are going. We've seen the oil price come down quite significantly in just the last few days as we think about the reopening of the Strait of Hormuz, that free movement of vessels through the Strait, global economy just regaining access to the energy from the Middle East. But I think it's fair to say that for Iran, they want to maintain a degree of control over the Strait. Clearly, that leverage is going to be very important to them, and they think about their relationship with the West and the rest of the world. But it also strains that relationship within the Middle East. And you mentioned Israel there. Does this create, a less stable Middle Eastern region? And should we just be there thinking about adding in a greater risk premium to the price of oil and gas from here on out?
There's a saying in Washington with respect to the use of economic sanctions that the moment you use them, you degrade their power for future use. Iran may find that a similar dynamic has just played out with the ability to assert leverage over the Gulf. I think there is a fundamental miscalculation on their part, maybe based on a playbook that would have been true even just a few years ago, that closing the Strait of Hormuz would cause such acute pain, which I'm not denying this very real disruptions that did occur, but perhaps wasn't as extreme as they were hoping, that would then concentrate attention and pressure on Washington to capitulate. We often talk about death by 1,000 cuts. This is probably a moment where we saw salvation by 1,000 bandages. When you think about the extraordinary shale revolution that occurred in the United States, the equally extraordinary renewables revolution, both in and being exported from China, the fact that even with the Strait nominally closed, transponders off, lights off, oil was flowing out, proved the importance of stockpiles, which was the lessons of the first oil embargoes, the activation of the Arabian pipeline, all of these things acting in concert, in addition to just the countless decisions of individual consumers and businesses, released some of the pressure that we were seeing. And I think as a result, limited Tehran's ability to channel global pressure on Washington to back away. Before at least the harms compounded so much to their own economy. Where do we go from here? I think the rest of the world is already moving decisively that they will not allow this happen again. You're hearing it's a reaffirmation of all the pushes for resilience that you're seeing, not just in energy, but in sectors beyond it. And certainly it was just coming here from Southeast Asia. I think some real lessons that they are learning already as they're thinking about greater integration of their power grid and so on. This is perhaps the peak moment of the ability that the Gulf will have over the global economy.
Yeah, that energy intensity in terms of GDP seems to be coming down, and certainly as we tracked it, it was surprising that the shortfall of oil, considering we were losing effectively 20 million barrels a day, didn't really show up that much. So whether it was the potentially weakness in the Chinese economy, those releases of the strategic reserves, or just the shuttering of some economic activity, it was remarkable how quickly that sort of demand side responded to that supply shortfall, whereas typically that doesn't happen in the energy market. So, and then for our side, when we look at where the oil price is, we certainly think that rebuilding of reserves, that I guess redundancies and extra investment that goes in actually would be a reason to think about the oil price staying a little bit higher for now. But I think that supply-demand balance is obviously going to be so critical from now. I want to bring that out to a little bit broader. We think about the choke point that was the Strait of Hormuz, but when we look around the world, there's obviously other choke points, whether it's the Panama or Suez Canal, or the Strait of Malacca, the Strait of Malacca. Where we think about those other choke points, countries now looking at what Iran did and thinking about, well, maybe I want a bigger piece of the pie here. How can I exert my influence over these key strategic waterways? Is that a risk, or is that just something that we shouldn't really think about?
I think it's actively shaping the actions of leaders around the world. We can start in the Western Hemisphere with Panama, which featured very prominently early in this Trump administration as part of their broader national security strategy focused on the Western Hemisphere. You then, move eastwards. We see coming out of Iran's threats to impose a tolling regime, which looks as though it is not part of any peace agreement. But we heard a minister from a Southeast Asian nation saying, "Why can't we do the same in our region?" We talked to embassies of other countries in the region who batted that down and reaffirmed their commitment to freedom of navigation. But you'd have to imagine it was on the minds of others. And then as we look up north to Beijing, the president there just hosted the leader of Myanmar, and one of the main deliverables or signals coming out of that visit was a reaffirmation of the importance to China of the infrastructure projects that will ultimately allow it to have direct access to the Indian Ocean through Myanmar. And so that race to both exercise leverage and to remove vulnerabilities from these geographic choke points, there's supply chain choke points, no shortage of other forms, that is actively animating policymaking in almost every capital.
Mm. I think there's a difference there because countries are allowed to charge for the provision of services to shipping, but that's different to charging a toll. Yes. So I think there's a slight difference in terms of how the shipping actually works around the world. Not that I'm an expert in that by any means. I do want to come on to China, given that is a strong field of interest for you. But before we get there, can we just talk about the other big energy shock we've experienced in the last few years, and that's obviously Ukraine, Russia. Seemed like that was more of a catalyst for countries having to really pay attention to their own energy security, particularly in Europe. However, unfortunately, it feels like that has taken a back seat to what's going on, even though it's been going on for a number of years now. Markets are remarkably cold when it comes to looking past a lot of these things. There's been a significant fiscal response from Europe. It's increasing its spending on defense. It's increasing its spending on security for energy, but there's really little sign of a deal between Europe, Russia, Ukraine, the US. I mean, is there an off-ramp to that conflict in the same way that there's an off-ramp to what we're seeing in the Middle East?
I think what's so interesting that as we are speaking, the G7 has convened, and as understandably Russia, Ukraine is very much continues to be on the minds of leaders in Europe. What was striking, of course, we had another image of a sit-down between President Zelensky and President Trump. President Trump now saying, as he is moving away his attention from the conflict in Iran, he says, "I can spend more time now focused on the war in Ukraine, and one of the signals is an attempt to impose greater pressure on Russian energy, and therefore the Russian economy, as part of a bid to help bring them to a deal. My sense is that is going to remain elusive through the end of this year. There's been a lot of commentary about this relative success of Ukraine's ability to conduct long-range drone strikes. Of course, that's balanced by this access that Russia still has over Ukrainian airspace, and to essentially be able to strike at will, and the very real costs that poses, starting with but not limited to morale. I think we're looking, in all likelihood, at another tough winter.
Yes, it does seem to be a case of not really seeing too much in the near term on a resolution. Moving away from sort of more the physical warfare, and I guess I want to call it economic warfare. That might be a bit of a strong term, but that relationship between China and the US, you mentioned a couple of times there, President Xi and President Trump. Obviously, they met earlier this year, and they can meet a few more times this year, which is still quite positive. Trade is obviously still a big issue between the two sides. And they're trying to assert some sort of strategic dominance when it comes to technology. So the US has much more advantage in chip design. China has a bigger advantage in critical minerals. Obviously, energy production is not a big issue for them. And they kind of talked when they last met about reaching the steady state of just a strategic stabilization. Is that where we're at? Are they at a stable relationship between the two nations, or is there a risk of some sort of deterioration and a renewed trade war between these two economic powers?
The phrase coming out of the May summit was constructive strategic stability. I think no one is under any illusion that while there is surface level calm, the fundamental conditions, intentions that exist remain in that relationship, and that there remains the downside risk. I like to say we're always a spy balloon. We are a two-slide regulatory maneuver by one side or the other, away from the cycle of the floor falling out, escalation, de-escalation playing out over again. When we talk to scholars and experts, particularly on the Chinese side, they feel that the structural conditions are such, as demonstrated by the ability to use critical minerals as a choke point, that we've now shifted for the time being, which they hope could last potentially not just through this year of diplomacy, but through potentially the remainder of President Trump's term, a dynamic in which strategic competition was increasingly going head to head, to one where it is now going back to racing in parallel race for self-sufficiency and in technological dominance. And the working assumption that whoever achieves greater self-sufficiency and dominance would then have the ability to re-escalate if they chose. There is hope that we can use this interim period. There's discussions around the Board of Trade, Board of Investment, for instance, to perhaps create a slightly more constructive foundation. But it's very clear that in many respects, President Trump, who has changed the political weather around so many things, including on China itself, is perhaps out of step with the broader Washington view of a relationship that is still predicated on strategic competition, and whether or not he'll be able to shift that weather again, or is ultimately the relationship is going to be overtaken by that more institutional view. We'll see.
Yeah, I guess when it comes to the current administration's view of, I guess, trying to enact their policy agenda or their outlook, particularly on the international front, trade and tariffs have been a key policy tool that they've relied on somewhat bluntly, and not just towards China, but to the whole world. Now, the US administration doesn't appear to be giving up on tariffs, even though the courts have pushed back on the IEEPA tariffs, as well as some others in terms of the Court of International Trade. We're still ongoing in terms of some of the industry and product-specific tariffs being investigated or in place around Section 201, Section 232, as well as these more recent announcements around tariffs related to importing goods that were deemed to have been created by forced labor. I mean, the tariff trajectory, it doesn't feel like any government's going to take away tariffs in the future that they've put in place. They may I guess, mitigate them to a certain extent. But once you get generating that revenue, it's pretty hard to give it up. Is the use of these tariffs to achieve these policy goals really going to continue, or is this going to be specific to this administration to a degree? Or what's the outlook for thinking about the US approach to that sort of international agenda and the use of trade?
Sure. Trump administration, when they look now at the year and change after Liberation Day, broadly a successful trade policy. They see in particular the near third decline in bilateral trade with China as indicative of the success and the change that they were hoping to engineer on the global economy. You are right that the courts are expressing skepticism of sweeping unilateral tariff authority. The administration is doing exactly what they signaled they would do and pivoting to the Section 301 and 232 investigations and process, which can be more legally durable, but is not beyond the possibility of a challenge, I think, particularly based on how the forced labor investigation was structured. There's still, I think, opportunities for a reasonable challenge to be made there. Where we go from here, we can look backwards from the transition from Trump 1 into Biden, where the tariffs on China were maintained. Where we go, and so I think you're right to operate from a working assumption, which is not limited just to the United States, by the way. We see in Europe a real reconsideration of their trade policy, thinking about, are we too narrowly product focused? Are we too procedural? Do we need to be more proactive, more sectoral in our responses, using more directed diversification levers? So this is by no means limited to the United States, which I think goes to your point that there's real staying power in this as an instrument. My sense is, of course, 2028 is a long way away in terms of the next presidential election. Still, the most important, or one of the most important agreements still to be reached, is the USMCA agreement between Canada and Mexico. But you could imagine that if there is a change in administration, keeping tariffs as an active part of industrial policy, but perhaps seeking to do so in greater coordination, in some degree of rationalization and prioritization, and to the extent possible with partners in the hopes of unlocking the next important piece, which is a broader common market that might be X countries of concern that are shared by some of those partners.
Yeah, we've definitely seen a pickup in I'm a bit biased thinking about Australia trying to put in place other trade agreements with like the EU, UK in advance of what's happened with the US. They try and at least strengthen their trade ties with those other markets to try and mitigate some of that impact from there. So I think that, again, is a direction, because we often talk about this fragmented world economy. We don't believe in deglobalization in our team. We think about the trade of goods obviously slowing, but trade of services being very strong still. So definitely a more fragmented world. And I think I wanted to ask you one last question around that. We talk about geopolitical concerns. The questions we always get are always related to the risks that are there and how we play that through thinking about portfolio construction, but kind of talked about a little bit on the investment side, the redundancies. It feels like there's some opportunity that comes with the way the world is shifting. Do you have areas of focus when you think about how this relates back to investing in markets, or how it could mean, potential upside might not be the right word, but that opportunity that comes through from this?
Yes, I think that the push for self-sufficiency or reduction in vulnerabilities that's playing out around the world, there's an aspect of that that's inherently duplicative and therefore inflationary. But there's also an aspect of this where we're seeing extraordinary release of creativity and thoughtfulness around leapfrog technologies and opportunities to obviate some of the current choke points through new approaches, whether that's technological, greater efficiency, and so on. And so ultimately, it could be less inflationary than if we operate from the assumption that it's a pure duplication. I think there's the fundamental technological trends, particularly in the energy space and renewables, is I think a cause of optimism. We see, around the world. Of course, this was very much driven in part by AI, consistent with your view, however, that global trade is by no means ending and is rerouting. But we actually saw global trade increase last year in volumes. And so you couple that record patent filings as evidence of still tremendous innovation activity. There's a lot to be hopeful for in this moment. And I think, particularly on some of the broader, from where we sit from a geopolitical angle, of evidence of future stability, the fact that we've got more girls in school, 50 million more girls in school over the past decade. That's a positive. Still meaningful progress that's happening around the world from a public health standpoint. These things are fragile. We've got an El Nino year that we're heading into. We've got the fertilizer shock coming out of the Gulf. But there are absolutely reasons at every part of the value chain in countries around the world for real optimism about the world ahead.
That's fantastic. I mean, it's always good to end on a slightly higher note, Kyle. And just again, I mean, it was great to have some time with you today. I think we could talk for hours. For our listeners that would like to hear more from Kyle and his team, as I mentioned, you can sign up for a newsletter on our website. That's the JP Morgan Center for Geopolitics, and get all their insights as they come out. They've released some fantastic papers. The most recent one about AI and US and China, and some of that sort of strategic dominance they're going in play there. But for us, thank you for listening. If you enjoyed the podcast, please share it with your colleagues or consider subscribing to future episodes. Kyle, thank you so much for your time today and joining us and letting our listeners in on our views around how the world is shaping up.
Thanks so much.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase and Company and its affiliates worldwide.